market fake-out or electric breakout. Ultra-loose monetary policy and massive government stimulus sent the S&P 500 soaring into record territory after the coronavirus pandemic. Whether you're a fund manager running a $100 billion fund or a retail investor, the buy-the-dip strategy was in full force. Many sectors caught fire that the average rookie investor got hooked to: meme stocks, Reddit stocks, SPACs, NFTs. Any major dip was quickly swallowed up by stimulus checks and cheap leverage, which drove share prices to record highs. Take a look. The uptrend is clearly broken over the past 6 months as share prices on average declined 23% in the S&P 500. Share prices have bounced hard off the low, gaining nearly 13% over the past few weeks. This is all the YouTube gurus and TikTok option traders calling that the bottom is in. However, you'll notice that after the recent bounce off the low, we have met resistance right at the trend line. The next few weeks will be key as the bulls and bears jostle to drive momentum back down towards the 3,000 level on the S&P 500. Or the bears will capitulate out of their short positions and share prices could recover further. Valuations remain lofty. The challenge with a significant further recovery is that we are not starting from an ultra low point of valuation. Valuations today are higher than the long-term average. You would think that with the war in Europe, soaring electricity prices, and high inflation, the market would be pricing in a lot of negativity. That's not the case. I'm going to show you a chart which shows a 1-year price to the next 12 months earnings for the S&P 500. Novice investors will rely on trailing 12-month earnings, but share prices are determined by future earnings, not past earnings. This means we should use forward-looking multiples for the S&P 500. As you can see in the chart, we briefly fell below the long-run historical forward PE of 15.2 as inflationary conditions and economic growth prospects slowed. This makes sense that inflation and a slowing economy would set in motion expectations for lower earnings. This rapidly fell by the wayside, and share prices and valuations have jumped, with the S&P 500 PE trading nearly 17 times next year's earnings. While only a single indicator, it appears the market has become complacent with the economic conditions at play. Fear gauge signals. The volatility index, which uses S&P 500 option pricing premiums to find the volatility, is one of the many fear barometers. Right now, the fear gauge is modestly higher, but there's no panic, as seen in the massive spike to 82 during the pandemic. I'd argue that you won't find true fear in the S&P 500 option market or in North America, period. You'll find it in Europe. Russia's Gazprom will halt the Nord Stream pipeline for routine maintenance. This has sent natural gas around the world skyrocketing. This has triggered massive spikes in already high European electricity prices and further declines in the euro versus major currency pairs. To make matters worse, the Rhine River levels have been falling rapidly, which could make it very prohibitive to ship coal and other goods along the riverways. European energy costs. Energy costs around Europe have skyrocketed. A combination of Russian gas limitations, low Rhine waterway levels, and low hydro levels have led Europe in a precarious situation. Here's a chart that shows a percentage change in natural gas, coal, and power prices in Europe. With costs soaring, this will put immense pressure on downstream users of power consumption. Power-heavy industries like manufacturing, refining, and petrochemicals all will face major cost surges. We are seeing the effect on productivity in real time. Here's an example. Poland's largest chemicals company, Grupa Azoty, has trimmed its production outlook. I expect to see more of this to come as the double whammy of limited natural gas supply and higher power prices take hold. In France, new orders in both services and manufacturing declined. France's economic output is contracting for the first time in a year and a half. This is the same trend seen in Germany as the EU has backed itself into an awful corner, seemingly no way out. Euro crash. Deteriorating economic conditions in Europe, coupled with the rising interest rates in the United States, created a firestorm of deterioration in the euro to levels unseen in 20 years. If you're an American or Canadian traveling to Europe, now is a great time for you. But are conditions perfect in the United States? Absolutely not. Here's a chart below that tells us they are far better than across the pond. Katusa has been a US dollar bull for many years, and it's his currency of choice. It's something he's spoken at length in his best-selling book, Rise of America. Many people hate the US dollar, calling it worthless. but anyone is yet to see a formidable challenge to the world's reserve currency. Unorthodox today equals the new normal tomorrow. Economic gloom only lasts so long. It's crucial to be forward-looking and to anticipate the next moves. Over the past few months, Marin Katusa has outlined his playbook in great detail to his subscribers. It's a strategy we intend on using to capitalize on the next big market moves, up or down. It's a bold, unorthodox concept, and it's contained exclusively in the pages of his premium research service, Katusa's Resource Opportunities. Find out more about his research and becoming a subscriber in the link below.
Subscribe to the KRO, which is the Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.